Hello and welcome to Stockwatch, presented by me, Evan Lucas for Go Market Securities. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which relied upon as any form of personal advice. Go Market Securities does not know your personal scenario, nor your personal financial goals, and therefore none of which relied upon as any form of advice at all, is just general in nature only. Westpac is out with its third quarter earnings numbers, and they are, let's be honest, a little bit soft, coming in at $1.8 billion. Not surprising considering although their headline net interest margins was up 10 bips to 10.06, it's the core interest margins that came in at 1.86, down 4 bips. That really needs to be highlighted. They are one of the most tight markets out there. The mortgage competition is more than offsetting the issues, or the benefits, that they're getting from higher earnings. And not only that, Westpac has its highest exposure to New South Wales. And I really want to go into these numbers because what I found fascinating about them was the credit quality that's in there. It is worse than NAB and also CommBank and what's reported, but it's also how it's done as well. It was found that 1.5% of its total loan book is now in some form of arrears, 30 days or more. You look into the 90-day arrears, in Australia it's at 0.8 of 1%. NAB was at 0.77, so very close. But if you look at CBA, it was at 0.44 of 1%. New Zealand's at 0.32, which is pretty impressive. But what was more interesting is things like personal lending and auto lending, that's really drifting. Auto particularly, it's out over 3% of their book. And then you look at the composition inside of it as well, it's just getting a little bit harder. And one of the biggest things I found that was quite interesting was the variable to fixed rate mortgage ratio, which was 67 to 33%, and now it's at 71 to 29. And their book shows that this is only going to get larger. It's probably going to get up to 80% or thereabouts inside the next 9 months. You then look at the credit impairment charges, it was higher at $5.1 billion. If you look also at risk-weighted assets, it was sitting at $7.1 billion. And then costs up 5%, driven by staff costs, inflation, and technology. Overall, it shows that Westpac still has troubles, and that's the term. It still has a long way to go to get through the issues that it's faced over the last 5 years. And its conundrum is that it's exposed to the highest indebted part of the country in New South Wales, and therefore the cost issues and pressures that could come with that inside their book. Overall, shows you again why NAB and CBA are much, much better positioned than Westpac, and we now wait to see what ANZ tell us.